All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Let's get to it. Market is what, down about 16 points last I saw here, and yeah, not nothing too aggressive on the downside, but certainly more sell pressure here today. Dollar General's up a little bit, but the option is down a little bit with the time decay here on it, and so the option is about 225, puts the challenge just over 4,000 here. We're not dealing with a stop exit level or anything that's coming into play, or time stop. We do hit our first time stop tomorrow, so if we don't see Dollar General rally, either into the close today and through tomorrow, or just somewhere in that time frame, I will move on here from it. That said, it's still a pretty nice chart. It's still in a pretty good spot here overall. But, it's one where I'd love to see a little gap up tomorrow and break above the highs from yesterday. That would be a nice pattern here for it. But obviously, we'll see kind of how that plays on out. As far as new signals, there are no new signals on the board right now. I thought we might get an Under Armour signal. And you'll see Under Armour on the scan for the downside 3-7 crossovers here. And Under Armour, is down about 38 cents here today. Now, they do have earnings upcoming here, but it's also one that if it were a signal, I could play it. There is enough movement with Under Armour that the risk-reward, it's not the best, but it's also not terrible. So, something that I was kind of hoping it would signal, but it's not. You can see the 39.1, well up here above 50. We typically will not see bear signals come in, at that area. But anyway, does have a downside 3-7 crossover. Nice kind of little consolidation wedge here, triangle, whatever you want to call it. Is it a bullish continuation pattern or a bearish breakdown pattern? Well, it'll depend on which way it goes from here. As do all chart patterns there. But anyway, not triggering here. On the upside, we have two crossovers, the same ones as this morning, I believe. Coca-Cola and Boeing. Yeah, Coca-Cola and Boeing. Boeing with a crossover here. This is one that, it's had earnings. We could play it if it were a signal, but it simply just is not a signal here. Now, this does have the potential to, be a crossover again, meaning we could see it, fade a little and then cross back up just because of this volatility right back here last week. But, we'll see how it plays on out. But so far, not a signal. So that leaves me in Dollar General, holding on to that and, in a sizable cash portion here. For the challenge. I do like, having cash here. I'd prefer to have a little bit of short exposure. I really would. But I don't have a signal to go after that here right as it sets. So anyway, I'll continue to be patient. Now, yesterday I mentioned that if you had any earnings that you wanted me to break down, take a look at, just shoot them over to support at Trader Minute, and Michelle forward those over to me, and her team will forward those over to me as they come in. We got a couple, and I went through them here today. I'll go through more over the course of the weekend here as well. Then Monday I'll do about a 30-minute video, kind of comprehensive on earnings season and what things are shaping up to be so far, and I'll include those stocks in that video on Monday. But one of the other things that got sent that was forwarded over to me was this argument about market valuations, and a bunch of different questions on different valuation metrics and everything else, but also included a link to this article that was posted today on Market Watch. And it's just a blog article. It says, "Do not buy the dip," warns investor who says brutal bear market looms, right? If it's Thursday on the market, you have one of these articles out there, right? On Friday, it says the opposite. On Monday, it's going to be flat. On Tuesday, it's going to be bearish. On Wednesday it's going to be bullish, and Thursday, it's bear day, right? So these are very common type of headlines out there in the market, and you keep in mind why they would publish, these types of articles. Well, they publish these type of articles because they get viewers to view it, right? You click it, you read it, maybe you could click one of the advertising links, but it creates views, right? And that's what the news sites are about. They're about creating views. So, it's just one that, after a while in the market, you just get used to seeing these and you're like, yeah, okay, next. But this one's kind of interesting, right? Occasionally I'll look at them, on the weekends more than any. But if we look at this one, right, it is a blogger talking about a call from Kevin Smith, Chief Investment Officer at Crescat Capital, and says the bear case for U.S. stocks has never been stronger, right? And it's time for investors to beware of the gravity of the current situation. Then he goes into this valuation, all right? And he brings up this chart here and says, look, we are dealing with sectors at record valuations right now, and that is why things have to go down. Okay. All right, that's fine. Well, what valuation metric are they using, right? Because there are tons of valuation metrics. The one they're using here is called your enterprise value to sales, right? Now, when we go and we look at individual stocks, you oftentimes will see me pull up a price to sales number, right? The price of the stock divided by their sales, and it takes out the earnings fuss, right? The part that can be manipulated. When it comes to enterprise value, it's similar to a price to sales. Only they take out or they add the debt into it, right? And so, if you're a high debt company, you're going to be a higher, you're going to have a higher enterprise value to sales number, right? And the bottom line is the higher the number, the, more expensive you are. And they show this, ominous chart here. It says percent of sectors at record valuations. And they go back here at the tech bubble. This is what the valuations were. And now this is what the valuations look like now. Almost double, what the valuations are. Right? And it's not that they are overvalued by this much. It's that they are in the 90th percentile of historical valuations. Right? And so one of the misleading facts with this chart, and they don't do anything to make it that, but it's one that could be easily taken as, wow, the market was overvalued by this much back here in 2000, now it's overvalued by double. No, it's not. It's looking at the the percentile. When you look at what the valuations are right now, historically, are they high or low? And right now they are historically high, and that's what they're showing, saying, look, consumer discretionary stocks are in the 99th percentile of, historic valuations. Utilities are, sky high, real estate sky high, industrial sky high, healthcare and energy, not as high, right? And so they're basically saying, look, what goes up has to go down. The valuations are so much richer right now that, we have to go down. This is going to lead to a bear market. Now, if you've been involved in the market for the last 5 years, you're going to hear that this kind of sounds familiar, right? It just really sounds familiar. What was the argument back in 2014? Back in 2014, it was all about the Shiller PE ratio, right? There was the Shiller PE ratio, and this thing was climbing and climbing, and it hit higher levels than Black Monday, and the only time it's been higher is in the tech crash, and it was now higher than what it was in the housing bubble, and it's just valuation, and we have to go down. Well, that was 5 years ago. That was 5 years ago, right? And to use a valuation to say, well, the markets have to go down, you're typically not going to hit a top or anything of that nature, right? You're going to be wrong for a long period of time, and that's the way valuations go, right? Valuations, whatever way you want to measure them, right? They are simply that. They are valuations. Now, valuations can change. And one of the things that value metrics in the market miss, they miss the bond market, right? They just absolutely miss the bond market. And if we come in and we chart like, $TNX, right, which is the treasury yield on the 10-year, and, we look at the yield prices here. Let me get rid of the indicators. Maybe. There we go. Clean that up. And then we'll just come down to a monthly chart. The yield on the 10-year right now is 1.6. 1.6. And it's one of those where you can just see how the yields have fallen, right? The yields back here in the .com, they were 5%, right? I mean, you could get 5% on your money here, pre-housing crisis, 4%. Now you get 1.6%? 1.6%, right? So if you do the normal flow of, hey, you know what, I'm worried about stocks, so I'm going to buy bonds, can you really do that? If bonds don't pay you, right? So the fact that the Fed has basically taken the bond market, ripped it apart, and thrown it away has created a higher valuation for stocks because you don't have the other alternative, right? If you're at the store and you're trying to buy 2% milk, right, and all they have is 4% milk, well, eventually you're going to, substitute and go for that 4% milk, even though, it may not be exactly what you want. Therefore, and you're going to ultimately be willing to pay up for it if they continue not to have the 2%. And so what happens is right now, we no longer have 4% and 2% or whole milk and 2% milk, at the store, right? We now have what? We now have one kind, and that is stocks. And so everybody's going to be buying the same thing. The valuations are going to go up. And this is what valuation arguments miss. They can say, hey, yeah, we are at the highest valuation levels in history, but we're also at the lowest bond levels in history. So it's not like we really have a good substitute. It's not like investors really had the choice to go out and sell their stocks and go buy bonds. And it's one of the reasons why in this graphic you see utilities, real estate, right? They are at their richest valuations ever. Nobody wanted utilities back at the tech bubble. It was only at 8. I mean, they were super cheap. Nobody cared about them. Nobody wanted them, right? Why? Well, because you didn't go buy utilities. You went and bought bonds if you were worried about things going down. But now you don't have that choice. So what do you have to do? You have to go buy utilities because they actually pay a dividend. And so you can get 3%, 4%, 5% that you can't get in the bond market. Same with some of the REITs, real estate stuff. You can get rates on them you can simply not get in the bond market. In fact, you can go out and buy, right? You can go out and buy a certain stock named Apple, right? This is a tech stock. This is up big over time. It's paying 1%. It's paying a dividend of 1%. If you go buy a 10-year note, you're getting a dividend of 1.5%. I mean, you can almost buy Apple for the same dividend as you get by buying 10-year treasuries. It's a pretty sad commentary of how the bond market's just been shredded. And the Fed made this conscious decision. In fact, not just the Fed, but central banks around the world made this conscious decision, and there's no going back. Right? There's no going back. The Fed cannot go out and say, well, you know what? We want to get this back to normal. Let's push it back to 5%. They tried. They created economic slowdown, and they backed off very, very quickly because political powers around the world have no incentive for a return to normal. Right? While central bankers can withstand a little bit of heat, politicians in democracies, they can't. They get voted out, right? So you can't have a long-term view. You can't go ahead and approach it that way. So it's just not going to happen. And, that's the nature of where things are. So to look at valuation metrics and to say, well, it's expensive, so we're going to have a big, bad bear market, might be the worst argument that any bear can make. There are way better arguments out there, right? There are way better arguments than this. So yes, could the market go down? Will these valuation metrics be pointed to if the market does go into a bear market? Yep. But the high level of valuations in 2016, 2017, 2018, 2019, they'll be forgotten about, right? And they'll go, yeah, see, look, it was high value, so things had to go down. Well, how much have they gone up when the valuations have been historically high, right? The S&P, how much has it risen with these historically high valuations? Right, I mean, here we go. Since 2016, the S&P was 175. Now it's just over 300. I mean, it's up big in that time. So if you sat back in 2014 and said, no, I can't be involved in the market, the valuations are just too rich, well, you're still sitting there going, I can't be involved in the market, the valuations are too rich. And, yep. We could be sitting here 4 years from now and going, yeah, historical high valuations. Ultimately, yeah, there will be a pullback. Ultimately, there will be a bull market. It almost always happens, right? But to say that it's valuations that are creating the bear markets or excessive valuations that are going to ultimately lead to the bear market, it just simply makes no sense when you look at what the markets are today and what the substitutes and alternatives are here today. The catalyst will have to be something different than valuations, right? The dot-com bubble, yeah, that was valuations without revenue, right? That was valuation without revenue. You had companies that, just were not, had no earnings. They had some revenue growth, but you know what? It wasn't, it was high growth, not actual high revenue. And so it was just, absolute negative earnings. And we don't have that today. I mean, we just simply don't have that. Nothing even close to it do we have today. Yeah, could we argue bubbles in other fashions? Sure. But people argue that there's a tech bubble out there. It's incredibly short-sighted, and it's an argument that preys on people's fears of what 2000 was. Apple is not what they were, or what tech stocks were in 2000. Microsoft is not that as well. These are companies that are making real money, real revenue with real products that are used every single day by consumers around the world. Businesses, governments, consumers, they have created this thing called the cloud. You might have heard of it, right? And it has provided incredible value for these tech companies. And it's only growing, right? It's only increasing. We're not seeing a decrease in the cloud at all. And so, we have real growth. This isn't just euphoric buying because, pie in the sky hopes. No, this is real growth with real product, and the type of growth that we see historically, tends to hold up. Right, this isn't bubble inflationary type elements. When it comes to the business models, right? You say, well, a lot of this is driven because companies are buying back their own shares. Yeah, it is, right? They can borrow money for dirt cheap and buy back their own shares and push the share price higher, but it's not increasing the valuations in a real way. It's not masking a fall in revenue growth for most companies. And so it's just one of those things that, it accounts for shares going higher, but it isn't this element of shares going higher while the company's losing money or shares going higher while revenues are going down. No, net revenue, gross revenues, they're rising while the stock prices are rising. And so these market valuation arguments, they're just, they're what they are. They're ludicrous, they're ridiculous, they're short-sighted. They have nothing to do with understanding how the market has changed over time. And will the valuation arguments eventually be right? They will, but it's not going to be the why. It's not going to be the reason that things go lower. And, the reason, well, there are 20, 30, 40 other things you can point to that will make more sense than a valuation argument. Thanks for hopping on. Have yourselves a fantastic evening. We'll talk to you tomorrow. Take care.